What's up, you guys? In this video, I wanted to talk about my top 3 investing tips for 2024. Okay, so I'm going to be using my Roth IRA. I do it on Robinhood just because it's simple and easy. You can do it on whatever broker that you want. But the very first tip that I wanted to give is to diversify if you're less risk tolerant. And if you're more risk tolerant, be a little bit more concentrated. So what does that really mean? Well, I've got a lot of stocks in my Roth IRA. You can see some of these, Waste Management, Rocket, Nvidia, SPY, Tesla, Google, a little bit of gold. So I've got a lot of different stocks. And the more stocks and ETFs that you have, the more diverse you are. What this usually does is it tends to decrease your risk. It does tend to dampen your gains a little bit unless you diversified really well. So ideally, we want to diversify across multiple asset classes. We don't just want to all be in tech. Even if tech is doing very well, cool. But if there's a drawdown in technology, then you're really concentrated in that one asset class. So I just want to go over some of my stocks in my portfolio, talk about the different purposes that they serve. So there's these yield max ETFs over here, Tesla, GUI, NVDY. Those pay monthly dividends and it's a pretty high yield. So it's pretty cool because it's correlated to the price of the underlying. So what does that mean? That means, hey, NVDY is correlated with the price of Nvidia. And what's cool is it goes up with Nvidia stock. If Nvidia stock explodes to the moon, yeah, I might not get as good of a return on NVDY as I would have on Nvidia, but this is more of like an income type of trade. So what does that really mean? Well, I'm getting paid monthly. So as you can see right over here, 15 shares, total credit of $9.39, and that pays out monthly. So I'm getting paid as I wait. So that brings me to my other point. Like, what type of investor are you? Are you looking for growth? Are you looking for income? Are you looking for more of something that's more stable? Maybe you're interested in bonds or bond funds. So right over here, this is VCSH. And what's cool about this is it's going to be pretty stable. It's not going to go up too much, not going to go down too much. It's a bond fund, but this pays about 5% a year, and that's guaranteed. So it pays it out monthly. And that's super cool because you get those interest payments coming in while you wait with very, very, very little risk. So this comes down to, where can I get certain rates of return? Okay, I know that I can reasonably expect about 5% return a year, taking very little to no risk in a bond fund. I could grab the S&P 500, which tends to average about 10% a year. Each year will be different. Sometimes it'll be more, sometimes it'll be less. But overall, you can reasonably expect 10% a year on SPY or SPY. And that itself is a diversified portfolio of 500 stocks. So take the extremes. What if you're all in on just Tesla? I know a guy that has, about a $3 million net worth, and he's got $500,000 in Tesla. He's going to make a killing if Tesla goes to the moon and goes to $1,000 a share. But if Tesla gets dropped and dumped in half, he's going to lose a significant portion of his wealth, but he'll be fine. He's diversified in other asset classes. But that's an example of totally concentrated in one stock versus somebody like me, being in 60 different stocks and ETFs. It's going to have less risk, but also it's going to have less return. You can even take it to the utmost extreme. What if you own every freaking stock in the world? Well, that's probably not going to do too much better than a savings account. And a savings account, knock on wood, should be zero risk. You can do a CD, a certificate of deposit. Usually, though, you have to lock in your money for 6 to 12 months, but you get a guaranteed rate of return at the maturity of that CD. So there's just a bunch of different ideas. Gold is a nice, slow and stable investment, but it tends to underperform stocks in the overall market. So it's kind of like a placeholder for cash in my eyes. I like Google. Google's a company that makes good loot. They make good money. They're taking a lot of money from all those super chats on all those live streams. That's for sure. We got QYLD. That's a covered call ETF based on the QQQ, the NASDAQ. Calm. This one's an interesting stock. It's an egg producer, but it also pays a pretty good dividend. So if you want more like income coming into your portfolio, look at this one. 7.68% return a year. That's pretty good for a stock that has stabilized and just kind of, maybe not overall uptrended, but in the past 3 months it's done well. Past, 1 month has kind of been flat, but the dividend itself pays out. So what are you going for? Are you going for a mix of growth and income? I like to go a balanced approach of being in bonds, a mixture of income, and just a little bit of growth. If the market goes through a deeper correction and it's showing signs of a recovery, then I might look towards growth. If I'm expecting the market to be stable or if it's a bit overbought, I might go a little bit more conservative or looking more towards income. So that's something to consider. So in this portfolio, in this account, what I like to do is I like to invest. I like to take a little bit of short-term swing trades, but I also like to position trade. So think position trade is usually 1 month, to let's say like 8 months. Investing is like 1 year plus. You're trying to get that long-term capital gains tax. And then of course there's day trading in and out in a day. I'm not going to do that in a Roth IRA. Okay. So here's some other diversified portfolios: VEA, SPHQ, IVV, VNQ. And then you got some short-term trades that I'm in. I like ABR. That's investing in real estate without actually having to invest in real estate. So the whole point that I'm getting at is tip number 1 is diversify. If you want to have less risk, diversify more. If you want to have more risk but more reward, diversify less and really pick well. Okay? So my second investing tip is know your risk tolerance. Ask yourself, how much am I willing to lose first? And then once I've accepted that loss, then it's nothing but upside. I can take all those gains, right? If you're not willing to lose, 10% in a year, you probably should just be in something like bond funds, because being in the overall market has risks. So you got to have some level of risk tolerance to invest. And you also got to consider other factors like where are my assets located? How much do I want in savings? Do I have like special events coming up? Do I have debt to pay off? Do I have a wedding coming up? Do I want to buy a house? Am I going on a vacation or saving up for a vacation or maybe a business vacation? So that's something to consider. Here are some more things. I think XLE can potentially outperform for the next year and a half. I like uranium, URA. That pays a dividend. I like MO. That pays a dividend. I like XLV. That is more likely to outperform in the next 1 to 2 years. TIP, that's an inflation bond. So if inflation is super high, that bond will pay me more of a yield. If inflation is low, that bond will pay me less of a yield, which is pretty cool. And just a quick reminder, as interest rates rise, bonds tend to drop. If interest rates are getting cut or being lowered, bonds tend to rise. All in all, though, they're a pretty safe investment because you get what you pay for. So if you're buying bonds at a really low price, you might, if the bonds start to rally, boom, you get a move on that actual equity itself. So an example of this would be like on IEF. So IEF over here, again, I'm up 4.65%, pretty decent. And it's only 2% of my portfolio in this portfolio, but the bond itself can rise. It pays you every month to hold it. And if the bond is rising, that means interest rates are dropping. But if the bond starts to drop, that means that interest rates are rising and I'm going to get paid more every month. So it's kind of like a win-win-win scenario for me at this point. So I do like bonds, at least at these prices and at this point. Occasionally, if the market gets really overbought, sometimes I'll, hedge a little bit and buy some like SQQQ. And that's just slightly underwater right here, as you can see. So sometimes I'll do that. And that's, down 2.6%. That's okay. That's boosting my risk-adjusted returns. So if the market does have a big dump, I can just, take off the SQQQ. And it's kind of like I got to hold my stocks without actually having to sell them, if that makes sense. Okay? SWBI pays a good dividend. PP, that's Meet Kevin's Pricing Power ETF. That itself is a mini diversified portfolio. So I like that. And there's some more tips right over here. FBY I like. Uber I like. Let's see if I can get some oversold conditions to buy. I like to buy when it's a bigger down day, but it's showing signs of a recovery. That way I'm kind of getting a better deal. If you just keep buying on like massive green days, you might not build that margin that you need for it to really grow into. But again, it depends on your time horizon. The longer your time horizon, the less the short-term buy price matters. The shorter your time horizon, the more important that short-term buy price matters. Okay? GOLD, that's okay. I might cut some of the gold trades I have. You know, RCL looks okay to me right now. PFE, Pfizer looks okay. So yeah. USOI that pays dividends as oil kind of goes sideways and chops around. So that's another idea. So tip number 1 is diversify. Tip number 2 is know your risk tolerance. Are you aggressive? Are you conservative? Or are you looking for income, kind of like me? Or something of the mix, you know? And of course, if you're young, you probably want to be in more stocks. If you're old, maybe you move a little bit more towards bonds, but it also depends on the macro environment at that time. So that's why it's important to study all this. You can diversify into other countries. Here's ARGT, Argentina, starting to show some promising growth. So cool stuff. CRWD, Crowd. The CEO is very good over there. FINV, Trin. Cool. So all these stocks are in my portfolio. I like waste management. Sometimes the most boring investment can be some of the best investments because it's not crowded. Everybody's not talking about waste management versus everybody's talking about NVIDIA, which is fine. You know, NVIDIA's done well for the portfolio, making 130%. So pretty cool. Lastly, my last tip is to start investing now, even if it's just a little bit, even if it's just $5. Try to do a little bit more. Try to do like $100 a week, $200 a week, maybe $500 a month. Try to max out your IRAs and Roth IRAs because that's going to be helpful for you in terms of taxes in the long run. And yeah, start now, build your empire. That's what we preach over here at the Legion. Okay, so this is a video format of what I wrote in terms of an article for Big Money Methods. So I'm going to post first link in the description. It's totally free to sign up for Big Money Methods. That's what my mentor, Brandon Carter, started with a bunch of his friends. And it's really good articles. There are some really good articles. You definitely want to check them out. Give them a read, okay? All right, you guys. Peace out.